Welcome to the Deep Dive. This is where we take, a whole stack of sources, earnings transcripts, market data, and boil it all down into something useful, some actual intelligence for you.
Yep.
Today, we're digging into Orrstown Financial Services, that's ticker ORR. We're focusing specifically on their Q3 2025 earnings, which came out after the close on October 21st, and the investment call they held the next morning.
And our mission today really is to figure out what drove that pretty substantial positive market move. Orrstown shares jumped, over 4% after this?
Yeah, that's right.
In this regional banking environment, the KRE index is basically flat. Banks are fighting margin pressure constantly. So a move like that, it just screams internal execution, right?
Absolutely.
We need to get behind the numbers and see what management, led by CEO Tom Quinn, actually did to earn what looks like a really quality beat.
Okay, so let's start right there with the hard evidence. What were the headlines? What first grabbed the market's attention?
Well, it was a very clean beat, and that suggests their operational leverage is really starting to kick in. They delivered GAAP diluted EPS of $1.13.
Okay.
Now, the street was looking for $1.06, so that's a solid 6.6% beat right there. And crucially, they backed it up on the top line, too. Total operating revenue hit $64.37 million.
Which beat the consensus, too.
Yeah, comfortably beat the $63.1 million estimate, so about a 2% beat on revenue.
And while, the year-over-year revenue growth was, let's say, modest at plus 0.5%.
Right.
In this environment, beating estimates by that much suggests they're managing those rate headwinds much better than a lot of their peers seem to be.
Exactly. That's the context. And management, well, they weren't shy about it. Tom Quinn actually called this their strongest quarter on record.
Wow.
And when you look at the profitability metrics, you can see why he'd say that. Their return on assets, the ROA, hit 1.60%.
That's high for a bank.
It is. And their return on equity, ROE, was knocking on the door of 16%, came in at 15.7%. For a regional bank today, those kinds of numbers put them, right near the very top of their peer group. It's really hard to argue with results like that.
Okay, but here's where it gets really interesting, I think. Because high profitability, it often comes from maybe taking on more risk or really aggressive growth.
Sure.
But for Orrstown, it seems like this success is tied more structurally to efficiency. And that's kind of the key proof point for their merger integration, isn't it?
This is it. This is the core of the quality beat thesis, I think. The market rewarded them because they proved they can actually cut costs effectively. Non-interest expense went down by a pretty substantial $1.3 million just quarter over quarter.
Yeah, $1.3 million is significant.
It is. And that reduction, it basically confirms that the Codorus Valley merger integration from 2024, it's moving past that messy transition phase, and they're actually realizing the synergies they talked about.
And you see that directly in the efficiency ratio, right?
Yeah.
Which is the number every bank analyst watches like a hawk after a merger.
Exactly. And the drop was, dramatic. It went from 60.3% down to 56.4%. That is a huge improvement in just one quarter.
Yeah, that's a big move down.
It's a massive win. And it really shows the, let's say, structural integrity of their cost management efforts. Management was pretty clear, too. Their main operational goal continues to be getting that ratio below 55%.
Sub 55.
Sub 55. And based on their forward guidance, they seem pretty close. They're guiding for a quarterly run rate on expenses of around $36 million going forward, plus, standard inflation. It shows they feel they've got a good handle on that baseline cost structure now.
Okay, so proof point one. They can cut costs post-merger. But in banking, costs are only like half the equation.
Yeah, correct.
Can they hold the line on revenue? Which brings us to that perennial question for all regional banks. It's margin management. What did the CFO, Neelesh Kalani, say about their net interest margin, their NIM?
Well, the NIM was surprisingly resilient, actually. It increased by 4 basis points quarter over quarter up to 4.11%.
Increased in this environment.
Increased. Now, we do have to pause here for a second. That 4.11% figure, it's not entirely, let's say, organic. It got a boost of about 52 basis points from something called PAA.
Okay, let's unpack that acronym. PAA, Purchase Accounting Accretion. What is that, and why does it juice the NIM?
Yeah, it's really important context. PAA is basically a non-cash accounting benefit. When Orrstown acquired Codorus Valley, they acquired their loans too.
Right.
Those loans often get marked down to fair value on the balance sheet, kind of like buying them at a discount. As those acquired loans pay down or mature, the bank gets to record the difference between the face value and that discounted price. That difference is PAA.
Okay.
And it temporarily boosts the reported NM. So it's a real benefit from the merger structurally, but it doesn't quite reflect the sort of core ongoing earning power of the bank in the same way.
Okay, that makes the guidance even more critical then. So even acknowledging that PAA benefit is in there, the guidance CFO Kalani gave sounded extremely confident.
It really did.
They guided for NIM to stay stable, targeting a range of 4.00% to 4.15%, even through the next couple of cuts from the Fed.
That, to me, was maybe the single most compelling statement on the whole call. You've got an environment where basically every bank is bracing for rate cuts to just squeeze their margins.
Yeah, compression everywhere.
And Orrstown is basically saying, hold on, we think we have levers to pull that will mitigate that pressure. And those levers, they really center on proactive liability management, managing their funding costs.
Okay, let's talk about those levers then. What are the sort of two big moves they've made that give them the confidence to forecast that kind of min stability?
Okay, first, they actually executed a reduction in their deposit costs very late in Q3.
Okay.
This is them actively managing what people call the deposit beta drift. That's just a fancy term for how quickly they pass rate changes onto their depositors.
Right, how sticky the deposits are.
Exactly. So by cutting deposit costs late in Q3, the full positive impact of that move should really land cleanly in Q4's results.
Okay, so that tackles the incoming cost of funds side.
Yeah.
What about existing, maybe more expensive debt that was weighing on them?
That's the second move, and maybe the more dramatic structural one. They strategically paid off early $32.5 million of subordinated debt right on September 30th.
Okay.
Think of it like, I don't know, cutting up a really high-interest credit card just before the big payment is due. That sub-debt was carrying an exceptionally high rate, 7.72%.
Wow, 7.72%. So pulling $32.5 million off the books at that rate, how significant is that for like structural margin defense? That feels like an immediate clean saving.
It's huge. It just immediately lowers their long-term interest expense burden. It provides a structural lift to the margin that really has nothing to do with where market rates go next.
Right.
This move alone helps insulate them quite a bit against potential compression if and when the Fed does cut rates. But, management was realistic too. They were very explicit that competitive pricing, fighting for loans and deposits in their local markets, that remains the big swing factor. They still need to compete hard to stay within that 4.00% to 4.15% range.
Makes sense. You can manage your structure, but you can't control the competition.
Exactly.
All right. So they seem to have stabilized the expense base. They've put up some structural defenses for the margin. Let's look at growth. Where is it coming from? How's the pipeline? And what about fee income?
Loan growth for the quarter on an annualized basis was pretty solid at 4.9%.
Okay.
They said the pipeline remains healthy. Their focus seems to be very much on a high engagement sort of relationship banking model. They're particularly targeting some of the faster growing metro areas in their footprint, places like Baltimore, Lancaster, Harrisburg.
Trying to win business there?
Yeah, they're trying to differentiate by offering, speed to market, local decision making, especially for that middle market segment.
And does that high-touch strategy seem to be filtering through into their non-interest income, the fee income side?
It definitely looks like it. Fee income came in really robustly at $13.4 million. That's nearly 21% of their total revenue for the quarter.
That's a good chunk, diversification.
It's a fantastic revenue buffer, especially when the NIM story can be so volatile for banks. They guided for a normalized quarterly run rate for fees between $12.5 million and $13.0 million going forward.
Okay.
And they pointed to a few specific drivers, too. They had a strong $800,000 in swap fees this quarter, really good performance from wealth management, and just steady increases in service charges and interchange revenue. It looks like a pretty well-diversified fee stream. Suggests that relationship model is paying off across different channels.
So if we kind of zoom out a bit, we can see this strong overall performance, the $1.13 EPS, the high ROA, that big drop in the efficiency ratio. It all kind of points to this being the definitive proof that the big execution risk from the Codorus Valley merger is finally mostly resolved.
I think that's exactly right. It's the merger payoff synthesis point. The integration risk seems largely priced out by the market now, and their capital position reflects that stability too.
Right.
Tangible book value per share, which is always a key metric for bank health, it's now back to where it was before the merger, hitting $24.12. And their tangible common equity ratio, the TCE, is at 8.8%.
And what does a healthy TCE, like 8.8%, tell us? What does that mean in terms of their ability to maybe absorb potential credit issues or even just support more loan growth?
It basically confirms they have strong capital buffers. TCE is crucial because it's their equity minus intangible stuff like goodwill. So an 8.8% TCE gives them capacity, gives them flexibility. They can keep pursuing their loan growth strategy. They can handle unexpected bumps without having to immediately slam the brakes on everything or, dilute shareholders by raising more capital.
Okay. But no regional bank discussion is ever complete without talking about risk and asset quality.
Never.
Management made it clear their philosophy is, quote, we lead with risk. So what do the details on credit quality actually reveal?
Well, overall, asset quality still looks generally sound. Net charge-offs were pretty nominal. However, non-accrual loans not currently paying as expected, they did increase by $3.8 million.
Okay, that catches the eye.
It does. But management was quick to clarify that increase was almost entirely tied to just one single relationship within their commercial construction and development portfolio.
Okay. So concentrated.
Exactly. It suggests it's more likely an isolated issue with one borrower, not a sign of broad deterioration across the whole loan book.
Right. That single name concentration is something to watch, definitely. But it doesn't necessarily imply systemic weakness yet. What else did they say about their risk approach?
They mentioned they'd proactively reviewed some relationships earlier in the year, and that sometimes led to slightly higher loan reductions than maybe expected, just to make sure the portfolio stayed aligned with their desired risk profile.
So proactive pruning.
Exactly. Signals conservative management, I think.
Yeah.
Just for context, their total classified loans ones showing some weakness stand at about $64.1 million. But the top 2 or 3 credits within that only make up about $20 million. And those span across a CRA credit, an auto dealer relationship, and some C&I credits.
Okay. And they also gave a little positive nugget about something that happened after the quarter ended, right? Regarding one of those non-accrual loans.
They did, yeah. They noted that one owner-occupied non-accrual credit actually received a $900,000 paydown after September 30th.
That's interesting.
It's a strong indicator. If a borrower is actively paying down a loan, even while it's classified as non-accrual, it kind of supports management's view that their risk classification might be conservative, and it suggests there's good recovery potential there.
Okay, so pulling this all together then, if we're watching Orrstown over the next, say, 6 months to see if this momentum holds, what are the key things we should be looking for?
Near term, I'd say watch 3 main things. First, can they actually hit the upper end of that $12.5 to $13.8 million fee income run rate guidance? That shows the relationship banking is still firing.
Okay.
Second, keep an eye on the speed of their deposit cost reductions. That deposit beta drift we talked about, it really needs to work in their favor as rates potentially fall.
Right.
And third, obviously, the big external factor, the timing and the pace of any Fed rate cuts. That just defines the whole operating environment for them and everyone else.
And then thinking a bit more medium term.
The 2 really mission critical items are, 1, actually achieving that sub 55% efficiency ratio target. That's their internal benchmark for proving operational excellence post-merger.
Get under the bar.
Get under the bar. And 2, seeing continued but prudent loan growth, especially focused on integrating and getting production from the new C&I middle market bankers they've hired.
Got it. Okay, perfect segue to our final segment. This is not financial advice.
My favorite part.
Where we frame all this analysis as if we were pitching it to an investment committee. So the setup is, the stock popped 4.37% on this news. The market seems to be rewarding these structural efficiency gains, especially when the broader regional bank index, the KRE, was basically flat.
Right. So given that dramatic efficiency win and really strong structural defense they've built around the margin, here's an outrageous but plausible trade idea for the committee.
Let's hear it.
We pitch a long position in ORRF, driven almost entirely by this efficiency catalyst. The bet is that Orrstown significantly decouples from the broader regional bank index over the next, say, 2 quarters.
Decouples. That's bold.
Yeah.
Regionals usually trade like a pack. Why the decoupling thesis specifically?
Because Orrstown is demonstrating, I think, superior liability management that most of its peers just cannot replicate right now. That combination, the targeted deposit cost cuts, plus that clean one-time benefit from redeeming the $32.5 million in expensive sub-debt, it creates a cleaner run rate expense base and a margin stability that looks structurally superior.
Compared to peers who are maybe still bogged down.
Exactly. Compared to peers still struggling with leftover merger costs or maybe dealing with deeper, more worrying credit concentration issues, Orrstown seems cleaner.
So the trade structure would really be betting on Orrstown's specific internal execution story winning out.
Precisely. The trade could look like a highly weighted long position in ORF, maybe balanced against a short basket of other regional banks, ones that haven't quite resolved their merger expenses yet, or have more visible credit problems. The core bet here is simply on Orrstown hitting that crucial sub 55% efficiency ratio target within the next 6 months, locking in that operational leverage advantage.
A bet on execution and structural cleanup in a sector that's pretty starved for good news right now. Fantastic analysis. So just to quickly recap the key takeaways from this Orrstown Q3 print for everyone listening.
Go for it.
The result really confirmed that the post-merger model is working. It drove strong EPS and that dramatic improvement in the efficiency ratio. And management seems to be actively and maybe successfully defending the net interest margin through aggressive liability management and those tight expense controls.
Yeah, that sums it up well. And this leaves us with maybe a final provocative thought for you, the listener, to mull over. Given management's stated confidence in holding their NIM around that 4.00% to 4.15% range, even with potential Fed rate cuts coming, how much of that stability do you think is truly replicable by their peers, just through similar pricing actions, versus how much of the success is actually unique structural synergy capture from their specific merger, something that others in the sector just can't easily copy right now?
That really is the key question, isn't it? Is this a stock-specific story, or is it a playbook others can follow? Something to think about. Thank you for joining us for this deep dive into the earnings call analysis.
Great discussion.
We look forward to diving into your sources next time.